Well, in today's episode of the Development Podcast, we are looking at MEGA and the question of risk when it comes to development financing. Junaid, it really is a great pleasure to have you on the Development Podcast today.
The pleasure is mine.
So, Junaid, many of our listeners would be familiar with the World Bank's traditional lending model, but guarantees are often a little less well understood. So, perhaps you could start by unpacking the distinction for us and just explain why it matters, particularly in the context of today's development financing landscape.
I think it's a brilliant question and one that I really appreciate because until 3 years ago when I joined MEGA, I'd spent 30 years in what you would call the lending part of the World Bank Group. And now I'm in the guarantee part of the World Bank Group, which I call the leveraging bank. So let me unbundle that for you. The traditional model of development finance, the one that the Bretton Woods institutions created right after World War II, was we were given an equity. On the basis of that equity, backed by several countries, we would go out and borrow on our AAA rating, and we would on-lend to a country. Mm-hmm. And it's our lending that creates the projects. It's our lending that supports institution building. But if you look at the development challenge, it is so vast that our lending just does not have enough finance to really back that up. Where is all that money? That money is in the market. You see that in the market, in the financial market. So the question is, how can we draw the financial markets into development? And that's where the whole idea of if we could de-risk, if you will, the development game for financial players, they would come in their scale. So the financial markets out there is what we want to tap. And that's what the guarantees do. The guarantees de-risk for the financial markets so they can come in. And the de-risking here is very specific. It de-risks political issues, not commercial issues. So if you're a financier or a business going into a country and you made a bad choice and your business went bust, tough luck. Entrepreneur, you made a shot, you didn't make it. But if you went in and government suddenly changed the rules of the game on you, that's a political risk. And that's what we de-risk. Regulatory uncertainty, political uncertainty, investment uncertainty related to policy choices, if you will. That's what we de-risk.
You know, you've said before that if you fix the risk, the financing will come. Now, that's both catchy and compelling, but what does it actually mean in practice? I mean, perhaps give us an example just to illustrate this principle, especially where it might intersect with the World Bank Group's focus on jobs and livelihoods.
Sure. So let's begin with an example of a guarantee that we provided that leads to the job story. In Egypt, for example, Egypt decided to create Africa's largest solar park. So it brought in private investors to produce electricity using solar energy. That electricity is being sold to a public distribution company in Egypt, which then releases that electricity to firms, to households. Now, this access to electricity, this infrastructure, is essential for jobs. Without electricity, you're not going to get firms to grow. Without electricity, you're not going to get schools to function. So the human capital side gets affected. Now, when the private sector came in to invest in the solar park, it began to ask the question, we're going to be selling our electricity to a public company. What ensures that that public company will pay us on time for the electricity we produce? Or let's take it one step further. The profit that I will make, as a company, I'll make some profit. I'm going to repatriate it back to my headquarters, right? What if government of Egypt suddenly put in a constraint that I couldn't transfer the money, right, out of the blue? So these are the type of risks that we want to come in and ensure that the private sector isn't facing. So if the private sector believes that there might be government interference, there might be, God forbid, political violence, war and civil disturbance, a company can't de-risk itself against those. So we come in and we say, should those things happen, we will come in and intervene and pay you, the company, while we will work with government to address the issue. So that's a real example. In the case of Egypt, when Egypt did in fact open the solar park and we de-risked it, the companies there were able to raise money at a rating that was 6 notches better than the sovereign rating of the country. right? And that's how much if you will, insurance or de-risking tools actually gave as a benefit. It resulted in lower cost of capital, which meant lower price of electricity, which gave that boost to Egypt in terms of, as you said, jobs.
And I'm curious about what you've alluded to in terms of risky environments or political risk environments. You know, in often cases, you'll look at fragile or conflict affected areas, and these are spaces in which investment is most needed but least likely to reach. How does this often play out in certain contexts, like Africa, for instance?
Well, two things. One is I truly believe that the risks that Africa faces are far less than the perception of that risk in the markets. And I think that both the countries as well as we as multilaterals need to do a much better job at showing that the risks that people are worried about, will I get paid for the contract I put in? Will there be an exchange rate failure that would prevent me from returning my money to headquarters? The perception of that risk, in my opinion, especially for sub-Saharan Africa, is much higher than the reality. And that's where I think the guarantee instrument of multilaterals like the World Bank, MIGA, that's where we play, I think, an important game. We come in and we try to bridge that perception. And that over time, within 2, 3, 4, 5 years, if outside they say, wait a second, there hasn't been a problem, why do we need MIGA? And MIGA leaving or exiting the project is a sign of success.
Well, let's talk about the Guarantee Platform, a new innovation from the World Bank Group and specifically MIGA. What makes this platform such a significant step forward for the group, and why do you believe it has the potential to change how we approach development financing?
Okay, but let me proudly say a few things about MIGA, and then I'll say a few things about the Guarantee Platform. MIGA was created in 1988. It's the youngest of the World Bank institution. There's the World Bank proper, which is the IBRD, IDA, and then there's IFC, which deals directly with private players. So MIGA was created in 1988, and it was a genius of Ibrahim Shihata, who was then our general counsel, who said there will come a point when markets will have to finance development more than a multilateral borrowing and on-lending. So MIGA was created, and we were given $366 million in terms of equity, which is a tiny bit of money. It's one loan of a World Bank, if you will. That $366 million, and we've never been capitalized ever since. World Bank got its capitalization, IFC got its capitalization over time. We never got any more than that $366 million. That has been converted to over $80 billion of guarantees since 1988. So for every $1 of our capital that we put into a guarantee, we crowd in $17. That's our ability to leverage. But we don't stop there. For every dollar we guarantee, we resell 70% into private reinsurers. That's how we were able to recycle that 366 into more than $80 billion of guarantees. So when Ajay Banga came in, he said, I have a secret weapon. It's called MIGA, but the problem is it's too secret. So he comes in as president at a time when this inflection of development finance has happened, where bringing in private financial markets or private markets into development now is the big, if you will, the name of the game. So how do you do that? And in discussions with the G20, which I think was the first group that had an experts group that said, we really need to use the guarantees to leverage market finance, followed by the private sector investment lab, which Ajay Banga put together, also put its weight behind the idea of a guarantee. And this is where Ajay Banga said, hold on, the World Bank has a guarantee instrument. IFC has its own guarantee instruments, and then there's MIGA that has its guarantee instruments. Outside in the market, private investors don't understand the difference of one over the other. Countries don't know which one to use. So what if we brought it all together into a guarantee platform, a one-stop shop, where a private investor or a country would know exactly what to get, because the information base would come from one place. That was the creation of the Guarantee platform. But there's something else that's very important about the Guarantee platform. IBRD Guarantee uses the IBRD balance sheet. IFC Guarantee uses the IFC balance sheet, and MIGA uses the MIGA balance sheet. One of the challenges we face is how do we serve our clients, be it Bangladesh or be it Nigeria, in which we optimize across the balance sheets. One balance sheet should not prevent us from using another balance sheet in combination if that helps the country. The Guarantee platform is the first step towards actually enabling the World Bank Group to work as a World Bank Group by enabling us to work across balance sheets. So let me give you an example. Côte d'Ivoire came to us and said they would like to use a policy-based guarantee to refinance some expensive debt that they had. So we gave a guarantee in which brought in cheaper finance to refinance an existing loan. That gave Côte d'Ivoire some savings. They used that savings to, in fact, finance additional expenditures in schools, right? Just from the savings of the guarantee program. And that was an IBRD IDA-based guarantee. The second phase of it was Côte d'Ivoire said, we want to put our money into sustainability-linked loan on ensuring forestation, ensuring water management. And so they asked us to go into the market, again, guarantee private finance. This time what we did was we said a percentage of it would be backed by IBRD, another percentage would be backed by MIGA. And the IBRD would act as a first loss against MIGA's guarantee. That brought down the price by another 200 basis points from the original IBRD guarantee. So the combination, which we would not have done before had we not brought the teams together, we did it, and that had a huge impact on Côte d'Ivoire. They were able to get loans of up to 15 years from the market, 10-year grace period, at 200 basis points lower than the IBRD guarantee itself, because we used the two instruments. That's the power of the Guarantee platform. It's, in my opinion, the future of development finance is going to be one in which World Bank Group acts as a World Bank Group, not acts in silos of its balance sheets. And I think that's going to be the legacy of Ajay Banga if we pull it off.
I mean, it's interesting how you describe the way that innovation leads to impact with this Guarantee platform. You've now reached a full year since it was launched. What lessons are kind of emerging about what it might look like going forward?
Many lessons, many lessons. So first, the lesson is this is where we become more client-oriented. We are able to combine our internal systems to deliver to the client a better instrument. So the first lesson is our internal systems getting improved gives a better option for the client. And the example I gave on Côte d'Ivoire. But it's not only combining balance sheet. The other is, as you'll know, environment and social due diligence is extremely important for multilaterals, including the World Bank. But the World Bank itself has one environment and social safeguards. IFC has its performance standards, and we're somewhere in between the World Bank and IFC. I mean, we do the private standards. And here, if IBRD begins a project, as we did in India, we began with these solar financing of the solar rooftop through the SBI. After a few years, private sector came in, so it made sense that the IBRD withdrew its money and replaced it with market money, and MIGA came in and replaced the IBRD loan. So this is a handover from IBRD to MIGA. But when we did that handover, the question was, should we redo the environment and social standards because that was IBRD that did it and MIGA is different? The fact that we are now beginning to have a common due diligence system makes us far more efficient, right? That's another lesson that we learned, where our systems are siloed and we have to bring them in. But I think, for me, the biggest lesson is the 30 years I spent in IBRD IDA and the last 5.5 years as country director India. If I had known what I know now of MIGA 1/3 of the portfolio of India would be different. And that's the lesson, is that if we don't create a system where the staff begin to move between the institutions of the World Bank, the culture, the thinking does not change, right? It took me 30 years to discover MIGA, right? And that too when I became a vice president. Now, I have to tell you, that's a cute story, but it shares the inefficiencies that are embedded in that. And I think we have now reached a stage under Ajay Banga when he says, I want to fix the plumbing. This is what he's trying to fix. We have got to be one institution that delivers to our clients in the private sector and the public sector an efficient system.
That does eventually impact people's lives on a personal level. I'm curious for you, having spent 30 years with the bank, 3 years now at the helm of MIGA, what comes to mind when you think about the impact of the work that you do, that, where you say to yourself, this is why I do it?
Well, I'm from Bangladesh, and my family comes from a village deep in the south, and every time I go back home, I go to the village. Last time I went with my father, who had been a government official, and we went to the village. And as we entered the village, the roads were absolutely spotless. I mean, it was really well-built road, because each year would come, the roads are muddy, it's very difficult to get into the village. We got there, and we were met by the chairperson of the village, and I asked, what's different for you today? They said, you see that road? We were able to get an IDA loan, and we won that IDA loan in a competition, and today I have that road. So I said, what difference does it make? He said, the big difference is at a time of rainfall, people are still able to go back and forth with the market, number one. Number two, the health clinic is about a few miles from here. During the flooding season, it's impossible for us to reach that health. Women that are about to give birth aren't able to cross the road. Now we're able to cross the road. Right? What a big difference it has made in our lives. Everything that I've talked about, balance sheets, crossing balance sheets, guarantees, these are technical terms, but this is not why we are here. We are here because we want the light to be lit in a school so a young child can learn. We want in a public space security so that women can get into buses that can take them to their jobs. We want a sense of security in a country that jobs are being created. We want foreign direct investments to come in to invest in Nigeria's electricity, in Burkina Faso's waterways, in my country's roads, right? That's what we are here for. When I see that in Colombia, because of our guarantees, 40,000 small and medium enterprises are able to get access to loans, that is an incredible story. Or in Cambodia, a $500 million program for women-headed enterprises, right? Changes the world. That's why we're here, and that's why we work. And today, going from the World Bank to MIGA, changing instruments, changing ways of financing, yes, but the development goal remains the same.
Well, a key focus of the World Bank Group's agenda now is jobs. It's seen as key to helping eradicate poverty. Tell us how the Guarantee platform and the work of MIGA also falls in with this objective.
I want to just step back in order to answer this very important question. If you think about the time of Jim Wolfenson, when Jim Wolfenson came in, there was a sense of 50 years is enough campaign that was going on regarding the World Bank and indeed multilateral development institutions. And there was a sense that we did not worry about social environmental impact. And one of the contributions that Jim Wolfenson did was he changed that narrative. He said, this institution not only worries about infrastructure, big projects, it worries about the social fabric of a nation, the environmental fabric of a nation. That was an important contribution that he made. And important in it that he brought in inclusion. He brought in the voice of the developing nations in determining the agenda. Fast forward to Ajay Banga. Ajay Banga comes in and he faces a big challenge that the demand on multilateral institutions is huge in terms of development finance, whether it's the climate story, whether it's the SDG story, the growth story. He looks at it and he says, one of the things that we have to do is ensure that people are getting jobs and they're getting good jobs. Because around the world, we're seeing political tensions, we're seeing fragility, we're seeing growth falling. And that's because we're not being able to create the good jobs that people want. And he positions that dialogue, if you will, of today's challenge and saying, what is it that we need to do to get jobs going? And he translates it and he says, you need infrastructure, you need regulatory certainty, government policy certainty, and you need private sector finance. That's where the big story is. And he then begins to ask the question, what is it in the way we are structured and the way we work that's preventing us from doing it? Mm-hmm. And that's the whole idea of the One World Bank Group, where some parts of the World Bank are extremely good at addressing regulatory issues, other parts are good at bringing in private sector, other parts, actually all three are working in different speeds on infrastructure. He begins to say, let's bring this force together and see if we can deliver on jobs. Mm-hmm. And I think that that's the shift that we're beginning to see today in the World Bank. Just as Jim Wolfensohn faced a certain challenge and he addressed it, Ajay Banga today faces the challenge of creating the One World Bank Group that will be able to deliver on the jobs. And he's very realistic in saying that the path to jobs is a path through infrastructure, through ensuring regulatory and policy certainty, and bringing in the power of private finance and private capacity.
Wonderful. Thank you.